In August 2020, a software company called MicroStrategy did something unusual. It took $250 million off its balance sheet and used it to buy Bitcoin, not as an investment alongside its real business, as the new primary purpose of the company. That decision created a new category of public company, the Crypto Treasury Company. A crypto treasury company is a publicly traded company whose primary purpose is to hold cryptocurrency, usually Bitcoin, as its main treasury asset. It still has a stock listing. It still has shareholders. It might still have some operating business on the side. But the actual point of the company, strategically, is to accumulate and hold crypto. MicroStrategy, now called Strategy, currently holds over 800,000 Bitcoin. That's about 3.9% of all the Bitcoin that will ever exist. It is by far the largest. But it isn't alone anymore. As of May 2026, around 180 publicly traded companies globally hold Bitcoin as a treasury asset, with combined holdings of 1.15 million Bitcoin, about 5.5% of total supply. The major players outside Strategy are 21 Capital with 43,000 Bitcoin, Metaplanet in Japan with 40,000. Mara, Holdings and Galaxy Digital round out the top 5. So how does this actually work? Treasury companies have a specific accumulation engine. They issue new shares of stock at a premium to the value of the Bitcoin they hold. Then they use the cash from those share sales to buy more Bitcoin. As long as the stock trades above the underlying Bitcoin value, every dollar raised buys more than $1 of Bitcoin per share. Existing shareholders end up with more Bitcoin exposure per share than they started with. That premium is called multiple on net asset value, or MNAV. Some treasury companies also issue convertible debt and high-yield preferred stock. Strategy pays dividends on its preferred shares between 8 and 11.5% annually, funded by the spread between Bitcoin appreciation and dividend cost. This is the key thing that separates a treasury company from a spot Bitcoin ETF. An ETF gives you a proportional share of a Bitcoin pool. Your Bitcoin per share stays roughly constant over time, slowly decaying by the fund's management fee. A treasury company can theoretically grow your Bitcoin per share through accretive share issuance. You're not just buying Bitcoin exposure. You're buying a company that's actively trying to increase your Bitcoin exposure on your behalf. But there's a catch. The whole engine depends on the premium staying above 1.0. If the company's stock falls to a discount versus its Bitcoin holdings, issuing new shares destroys Bitcoin per share instead of creating it. The engine reverses. That's not theoretical. Metaplanet, the third largest holder, currently trades at 0.87 times NAV. A discount. They've kept buying anyway, but they're funding it with debt and capital reserves, not the accretive share issuance that still works for Strategy. Most of the rest of the sector is in even worse shape. Outside of Strategy, treasury company purchases have collapsed 99% from their August 2025 peak. The risks are real. These companies are levered bets on Bitcoin price. If Bitcoin crashes hard, the premium collapses, dividend obligations can't be met, and the accumulation strategy breaks. Strategy has weathered multiple Bitcoin drawdowns since 2020. Whether the entire sector survives the next one is an open question. But the model has changed corporate treasury thinking. Bitcoin is now an option boards consider, not just a fringe asset. Institutional investors who can't hold Bitcoin directly can buy Strategy stock and get leveraged exposure. Retirement accounts can access it. Sovereign wealth funds get a regulated wrapper. The treasury company sector is the bridge between traditional public equity markets and Bitcoin accumulation at scale. That's a crypto treasury company. We cover crypto on the days that actually matter, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.